Hey guys, how you doing? In this video I'm going to talk about the key infinite setups. You can see it here. My trading day was quite busy, as you can see. Traded for about an hour and a half, an hour and 20 minutes. I traded the US market open. Ended up trading a couple times for a very nice profit. And in this video I want to show you exactly how you can find entries somewhere down here, how you can find entries somewhere up here, in between, and how you can profit along the way, how you can find the perfect entry price, how you can find the perfect exit price, how you can validate those trades, how you can make sure that your trade idea is actually valid, where to place stop loss and your take profits, and all of these things. This is going to be a video that's very interactive, so get ready because this video, you're going to like it. So first trade down here. Why? Why did it happen? And I'm going to go back to the replay function so you can actually go through the entire situation with me and you can see what is going on in the market at any given moment. And by doing that, you can see exactly how I was thinking in that moment, and potentially you can trade along the way. So the very first trade here was by using my market open strategy. The market open strategy is something that I made a video about on my channel, and it's something extremely easy. So every time the market opens up at 9:30 a.m. every single morning, we have a liquidity sweep. And the liquidity sweep is basically just the market grabbing the liquidity near the recent highs or recent lows. So in this case, we obviously have recent lows down here and some recent highs up here. Okay, perfect. We also have some recent highs here, but we broke through them, so that doesn't really count. So we know, okay, we have this high, we have this low, and the market, once it opens up, likes to sweep this liquidity, meaning it likes to go below this level, because here will be stop losses, guys. Okay, lots of sell orders. And in case you are a big hedge fund, a big bank, it doesn't really matter. In case you want to build a large position, what do you need? You need liquidity. Why? Well, because if I want to buy, let's say 1,000 contracts somewhere at this level, 1,000 contracts. If I would just buy 1,000 contracts at any given point, I would just move the market all the way up here. But I don't want that because I want to buy the 1,000 contracts in this range down here. And I can only do that if I know, hey, right here at this price level, there's already, for example, 1,000 stop orders. Perfect. So what do I need to do? I need to push the market below this low. I can sweep up these 1,000 sell orders, meaning I can buy. They want to sell, I can buy 1,000 orders, and that way I can build a huge position in a very short amount of time, and I can potentially profit from a very nice move to the upside. So 9:30 first trade was in the books, and I will show you exactly how that looked like in practice. So 9:30, you can see here that the market, and I'm gonna scroll out a tiny bit so you can see exactly what was going on. Bookmap, to be fair, is a bit slow, so I hope you don't mind waiting here for a couple of seconds. And here we go. This should be 9:30 right here. And that way, this is 9 o'clock, 9:30. So the market just opened up right here. Let me just double check that here because my cap cut is in the middle. There we go. So 9:30 right here. Okay. And what do we see? We had this low right here. So we know, okay, down below there's some liquidity, obviously. It's just what we talked about previously. And now we can see exactly what's going on here in that exact moment and how you can potentially trade this as well. And I need to zoom in quite a bit here. I'm sorry for all this loading, but it's worth your time, trust me. So 9:30, the market just opened up and we can take a look. The low was at 0.60. Okay, 0.60 was the recent low. So anything below will become interesting. The market opened up right here, and at the 60s right here, that's the level that we want to take a look at. And guys, we'll go through a couple examples because this is amazing, guys. And this is the key to infinite trading setups, by understanding how the market works. So we just broke below this low. We came back higher. And now we broke through this low again. Okay, so we want to sweep this liquidity. We see bad auction quality. All of that is not that important right now. What is important is we know the market wants to sweep liquidity. Big market participants want to build a huge position here. And where can they do that? Where can they do that? Very easy. At levels of liquidity. Where are here, in this case, levels of liquidity, guys? Well, we have liquidity here, 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 and here. Also, some here, but that's quite far away. Nearby liquidity is at these levels. And guys, what happens once all of this liquidity was swept? A move to the upside. So the market opened. This is the first candle. And this is exactly what happened. The market went below this level of liquidity. It swept all these orders. And this is what it looks like in real time. And once we swept all of these orders, all of them, you can see the market went sideways for a little bit. And once we broke this structure, meaning we have a break off structure going from lower lows to lower highs, you can see it here, downtrend, to making higher highs and higher lows. A break of market structure. And then once you get in, either at the 60s, so at the previous level of liquidity, or once the market re-enters here in this high volume area, or potentially somewhere down below here, which is at the 35s, 37s, so somewhere down here, you would want to sell at a previous level of high volume, because that is where resistance most likely will be. So you would want to sell at the 100s. Okay, cool. First trade of the day, market open, boop. You could be done for the day already. You could be done for the day. If you get in on the, let's say, 40s, somewhere here, you get in on the 40s, and you just sell at the 80s or at the 60s, 80 ticks to 160 ticks, guys. Very, very easy. But let's see what the market actually continues doing. Because the market does something interesting. The market actually keeps going up. Now, where could the market now turn around? Think about it. Where could the market want to go to? Where's liquidity, guys? Where? Where is liquidity? Look at this. Think about where could liquidity be? And I'll show you that in practice. I'll show you that in real time in just a second. But think about it right now. Where is liquidity? Look at the charts and you might be able to see it. I'll give you a hint. If you were a retail trader, which level would you like to look at now? Where do you take a look at? I'm going to zoom out a tiny bit. Maybe you can see it better. But let's say you are a normal trader. I bet you look somewhere potentially here, right? Why? Previous support. In the levels of support, we oftentimes have liquidity. Because smart money knows that at levels of resistance and support and resistance, the order doesn't matter. There's liquidity because dumb people, dumb money, dumb traders place their stop losses right there. And they need those stop losses to build huge positions, guys. That's how it works. Okay, so now that we know we have a potential level right here, we can also validate this a bit more. So at the 220s, somewhere in this range most likely, we have a low volume area, so the market can go through this extremely quickly. But let's actually take a look at the 220s, where I believe there will be some liquidity. To validate this a bit further, what I would like to see is a high volume node from the past, somewhere in that area, where I know, hey, there's also a high volume node, which means previous market acceptance, which now acts as resistance to the market because the market can transact as many contracts as possible, most likely at least, at those levels compared to previous low volume areas. And what do I see? Well, I see that we had pretty much a high volume node somewhere here. We had a high volume node up here. And now that I'm in between this range, maybe I find something in between. I don't know. I can go back a bit further because this is actually quite a long range. But if I don't mind. Here I can see a small area that was being built and lots of volume being traded there. Here was a high. Look at this, guys. Just this level. Rejection, rejection, rejection. So there was definitely some liquidity. So that's all I need. I now have these levels. And I need to look at what can the market do here. We know we have levels of liquidity, most likely here. We have a level of previous market acceptance. So now we just wait for the market to go into that level. And if it doesn't, we might find another idea. But for now, either you get in down here, or once you understand how this works, obviously, you can use this knowledge and trade longs all the way up here. I don't recommend that because we are in high volume areas. But once we get into low volume areas, you can potentially even trade longs here. So a break through this low volume area into potentially high volume areas, because those act, intraday at least, as level of resistance. So we keep going. And boop, what do we see? The market just pushes through this level. Interesting. We go through it. Okay. So this idea right now, not really validated for now because we swept all of this liquidity. We came right to our level of previous resistance, previous market acceptance. And what do we have here? We have 1, 2, 3 equal lows. Quite a few equal highs. I'm sorry. Quite a few highs here. So what is there? Liquidity, guys. Liquidity once more. We swept through all of this, so we couldn't find an entry, and I will show you this. So this is 950, guys. 950. And sometimes you might be thinking like, hey, but how do I know that I cannot go in for a short trade here? How do I know? Well, you need to look for an entry signal. And an entry signal at the market open looks different from an entry signal during the day. Okay? So 950, and we'll go there now. 950. Almost there. Okay, this is the exact situation. All of this liquidity, you can see here, I didn't even have to look into Bookmap. I knew there was liquidity. I knew it. But the market just went right through it. Why? Well, first of all, we have some more liquidity here. Second of all, it moved. You can see it. Did we have a break of market structure? No. We are still seeing higher highs and higher lows. We see no liquidity below. Liquidity acts like magnets to the market. Meaning, if you want to go in for a reversal trade, you would like to see liquidity come in nearby the current price with a change of market structure and a couple of other things. Bad auction quality and all that good stuff. This is excellent auction quality, excellent auction speed. So we know, hey, right here, no, we don't get in. We don't want to get in. So this level is not valid for us anymore right now. However, we are at the 250s now. And here at the 260s, I believe there could be some more liquidity. 250s, boop, a huge level of liquidity. It's right there. Right there. Huge levels of liquidity, guys. Exactly where there was a previous high volume nodes. Okay. So what can we do with this information? Well, for now, you can either scalp this or you can hope for a big trade. Okay. This move right here, a very extensive move, a long move, a long move. So either the market goes nearby this low volume area or we already reject somewhere here. We can check. We can see for now the market is moving up, is moving up, is moving up. We have this huge level of liquidity, which acts like a magnet to the market. And now for the very first time, let's check. The market comes nearby. Liquidity is moving up, guys. Still a bullish sign, obviously. But we have our first change of market structure right here. Bearish, right? Maybe not. Because what is this? This is an absorption, guys. At a previous level of liquidity. What does this mean? Usually, let's say the order book right here. You can see how many contracts are on the bid and on the ask. Meaning we have about 7, if I can see this correctly, 7, 12, 13 contracts on the bid, which means if 7 people sold at this price level, the bid should drop and we go to a lower price level. However, here we had 135 contracts that were traded, yet the market didn't go lower. So someone passively bought up all of these contracts. He held up the market. It's like a wall. He held up the market, and now the market can potentially move up. It's not sure. It's not exact, but it could work. Let's see what happens. The market keeps going lower for now. And there you see, boop, first move to the upside. And we still have this liquidity right here at the 50s. But wait, what happens? Lots of buying coming in, and this liquidity here is gone. 220 contracts with 193 contracts. Guys, 400 contracts. 400 were transacted at that price. 400. Imagine you're short 400 contracts now. 400 contracts. What are you hoping for? You're hoping to exit that position at a potential level of interest, either intraday or at previous days. So let's say you're short here at the 50s now. And you can see, like, you can trade this yourself. You know this is a level of interest, right? You know this now because you made your research. It takes 1 minute. You looked at previous days. That's all you did. Okay. You know this level is interesting. And then you see another abnormality to the market. Huge levels of orders. Liquidity is now gone. And the market has a change of market structure. Is it a surprise that the market is now selling off? And guys, look at this. From the 47s or 50s even, down to, let's say you only want to scalp this. Quick trades only, few seconds. Where is your first level of resistance? Well, previous levels of large orders and liquidity. So right here, from the 50s to the 30s, or 38s, I'm sorry. 12 points. 12 points. 58 ticks. 60 ticks, 58 ticks, it doesn't really matter. 1 contract, 2 contracts, 10 contracts, it doesn't matter. It can be big money, guys. 1 trade only. 1 trade only. Takes a few seconds, in and out. That's all you need. That's all you need. And what do we see? The market comes back to this area. And it breaks out. It's a breakout, right? Is it? Well, it's really a breakout? The market couldn't go lower than this low right here. It couldn't. What does the market need to go lower than this low? Well, it needs fuel to the fire. And where do we see more liquidity now? We see more liquidity come in here, which acts like fuel to the fire. So they can sell even more here. They can go short even bigger here. And we see some more liquidity coming up here. So look where the market went. Above this level, everybody now thinks, hey, this is a breakout, this is a breakout. But no, it's just smart money. Selling even more, going into the position even further. So you now can find a short at the 60s. And guys, what is at the 60s? Here, look at this. Low volume, a low volume area, a perfect level of entry. So you get in on the 60s, and where is your exit? Well, just looking at the volume profile, your perfect exit is somewhere at the 35s, a high volume node. From 60 to 35. You get in here, and now you want to get out of your trade here. Potentially even down here. But let's go for the 35s for now. You're in, you wait, you wait, you wait. Takes a minute or two. Still not in, still not out. You're still in your position. By now, you should be break even, obviously. Secure your position. So your stop loss should be somewhere here because we cannot seem to break this low right here. Very interesting. So right now, if you got in here, just by looking at this, we see, hey, some equal lows right here. Liquidity here, liquidity down here. Okay, the market had some liquidity here. It went lower. So it's another bearish sign. However, I would now make sure that I would be break even. So I had my entry somewhere here, potentially at the change of market structure, maybe even here. I would now move my stop loss to break even. Want to get out at the 35s, like I said, potentially at the 30s. What happens? Boop, the market sold off eventually. Okay. You had a zero risk trade at that point, and the market still went to your level of interest. Where did it go to, guys? To the 30s. Now, let me fast forward a little bit, because what is at the 30s? Somewhere here. At the 30s, to be fair, in my opinion right now, nothing. High volume node. I don't want to find an entry here. Where I do want to find an entry potentially now is maybe somewhere here. Maybe somewhere here in this level, because low volume area. Low volume area. So we are seeing an uptrend, right? Guys, one trade already, two trades, potentially even three trades already. In a few minutes. That's all you need. And by understanding how the market works. So now we see the market is trending up. Huge rejection here. Yet we're still in a long trend, obviously. So we look for low volume areas. So potentially from the 15s to the 02, 01, whatever it may be. And that's where we want to see something specific. So somewhere down here eventually. So we just fast forward now. And we can see absorption at the 28s. Absorption, interesting. 26, another level of absorption. And the market shoots up. The market shoots up. Why? As you guys can see, the market couldn't break this low right here. Why? It needed more fuel to the power. Where can it get that? Well, most likely, guys, where all stops are at. And where are all stops at? Above this high. Take a look at this. And is it a surprise to you guys that the market stopped right here once all of the liquidity here was grabbed? No more liquidity here, guys. We just got some liquidity. A big market participant traded hundreds, thousands of contracts all the way up here, all the way to the 80s. And I'll show you guys exactly where that is. Surprise, surprise. This move right here. And now we have enough fuel to the fire. Fuel to the fire to potentially go lower and break these lows. And that's exactly what happens. We break these lows and we go where? We go to the 220s, where the low volume area starts. What do we look for now? We look for long entries. We want to see that we have a level of absorption and all this liquidity needs to be gone. So 220 to the 200s roughly is our level of interest. So somewhere in between here and there, we want to see what's going on. And what can we see? We can see huge selling, yet the market isn't going lower. Liquidity coming in above. So we're now trading in this range, right? From here to here. Right now we cannot break these highs, but we also cannot break these lows. We now want to see, this is an accumulation obviously. The market is going sideways. What usually happens next is a manipulation and then a distribution. So what you do want to see is the market break out of this range to the downside and then shoot higher. And that's what happened. We broke out to the short side, entry here or entry there at previous levels of liquidity, guys. This liquidity is gone by then. And you get in, and that's how you trade. You either trade to the range here, to the 229s, which is also pretty close to the volume point of control at that time, or you trade it even further if you're risky. But to be fair, I would potentially go out here at this previous high, liquidity here, liquidity there. So that's a perfect level to exit your trade. And just like that, I showed you a couple of situations. but just by understanding how the market works, by understanding why the market moves higher, why it doesn't go lower or higher at certain points like these, where you want to look for accumulation, manipulation, distribution, all of these things. Just by understanding how this works, you can trade all day, every day, no matter what time of day. So without further ado, this is the key to infinite trade setups. I hope you like this video. In case you have any questions, let me know down below, and I'll see you guys tomorrow.